Ever pondered over the various types of option strategies? Well, you're in the right place. In the world of finance, option strategies are the keys to unlock potential profits and safeguard your investments. They are essential tools in the financial toolbox that provide investors with the flexibility to respond to ever-changing market conditions. In our journey today, we'll be exploring 4 basic yet powerful option strategies. We'll start with the covered call, a strategy that can generate income on your existing stock positions. Then we'll move on to the protective put, which can shield your investments from unexpected downturns. Next, we'll venture into the territory of the long call, a bullish strategy that profits when the price of the underlying asset rises. And finally, we'll delve into the long put, a bearish strategy that thrives when prices fall. Now that we've set the stage, let's dive into each of these strategies. First up on our list is the covered call, an extremely popular strategy. This strategy involves owning or buying shares of a stock and selling call options on that same stock. It's like a landlord who owns a property and then rents it out for income. Here's how it works. Let's say you own 100 shares of a company. You can sell a call option that gives the buyer the right to purchase your shares at a specific price, known as the strike price, within a specific period. The risk-reward profile of a covered call involves earning the premium from the sale of the call option, but potentially missing out on some upside if the stock price shoots past the strike price. For instance, if you own shares in a company that you believe will have modest growth, you could sell call options to generate income while you hold on to your shares. That's the covered call for you. A great way to generate income in a stagnant or slightly rising market. Next, we move on to the protective put, your insurance against a fall in stock price. Think of it as buying an insurance policy for your stocks. If you own a stock and you're concerned about potential losses, you can buy a put option. This gives you the right, but not the obligation, to sell your stock at a predetermined price, called the strike price, before the option expires. Let's illustrate with a real-world example. Imagine you own shares in a tech company, but there's speculation of a market downturn. To protect your investment, you buy a put option with a strike price slightly lower than the current stock price. If the stock price does fall, you can exercise your put option and sell your stocks at the higher strike price, limiting your losses. Meanwhile, if the stock price remains stable or rises, you only lose the premium you paid for the put option. So, that's the protective put, your safety net in a volatile market. Now, let's explore the long call, a strategy for the optimistic investor. Picture this. You're certain that a particular stock's price is set to rise in the future. Here's where the long call comes into play. You buy a call option, which gives you the right, but not the obligation, to buy the stock at a predetermined price, known as the strike price, within a specific time frame. Let's dive into a simple example. Suppose you buy a call option for Company X with a strike price of $50 expiring in 3 months. If Company X's stock soars to $70 within that period, you can exercise your option, buying the stock at $50 and selling it at the current market price, $70. That's a $20 profit per share. But remember, the risk is the premium you've paid for the option. If the stock price doesn't rise above the strike price, you lose the premium. So, a long call is an excellent strategy if you're banking on a significant uptick in the stock price. Last but not least, we have the long put, a strategy for those foreseeing a downturn. So, what's a long put? It's an investment strategy where an investor buys a put option with the belief that the price of the underlying asset will decrease below the strike price before the option's expiry date. In simpler terms, it's like betting that the price of a stock will go down. The beauty of a long put lies in its risk-reward profile. The maximum risk is limited to the premium paid for the put option. However, the potential reward is significant if the underlying asset's price plunges. Let's imagine you've got a hunch that a certain tech company's stock price is about to tumble. You could buy a long put option, and if your prediction proves correct, you stand to gain a tidy profit. That's the long put for you, a great way to profit from a falling market. So there you have it, 4 basic option strategies explained. We've dived deep into the world of covered calls, protective puts, long calls, and long puts. Each of these strategies carries its own unique risk-reward profile and is designed to help you navigate different market conditions. Let's take a quick trip down memory lane. Remember, a covered call is an income-generating strategy where you sell call options against an owned or purchased stock. It's a fantastic way to generate additional income from a stock you already own, especially in a stagnant or slightly rising market. The protective put strategy, on the other hand, is your safety net. By buying a put option for a stock you own, you're ensuring that even if the stock price plummets, you can still sell it at the strike price. It's an insurance policy for your portfolio, particularly useful in a falling market. Then there's the long call, the classic strategy of buying a call option in the hope that the stock price will rise. It's a strategy built on optimism and the belief that the market will move in your favor. And of course, the long put, where you're buying a put option in anticipation of the stock price falling. It's a strategy that thrives in a bearish market. Selecting the right strategy depends not only on market conditions, but also on your individual risk tolerance and financial goals. It's about understanding the nuances of each strategy and applying them effectively to capitalize on market movements. Choosing the right option strategy can be the difference between success and failure in the financial markets. It's a powerful tool in your trading arsenal, one that can help you navigate the often turbulent waters of the market with confidence and precision. Don't forget to hit the like button if you found this video helpful, and subscribe for more content like this. Please leave your comments below. We'd love to hear your thoughts or any questions you might have. Until next time, happy trading.